Three legal forms of business organization include sole proprietorship, partnership, and corporation. This video is about partnerships. Partnership is when two or more people share in operating the firm and also share in the financial responsibility for any debts incurred by that firm. Three parts of this definition are critical. Two or more people. So a partnership doesn't necessarily have to be limited to only two people. There can be more than two people involved in the partnership. These individuals are involved in the operation of the business. And, importantly, they share in the financial responsibilities of for repaying any debts that might be incurred by that business. Two types of partnerships we need to look at: general partners versus limited partners. Let's start with general partners. General partners are involved in the day-to-day operation of the business. They take care of hiring, the financial issues, fixing the computer, selling the goods, all of the tasks that are involved in the day-to-day operation of making the business successful. General partners have dirty hands. They get their hands dirty. Lots of questions that general partners need to ask each other. How are we going to share the authority? How are we going to spend money? What happens if one of us decides to leave the business? Although a written partnership agreement or contract is not required for a partnership to legally exist, it's a good idea. We want to get all the questions in writing early on. Advantages of partnership. Larger talent pool. One partner might be good at creating the artwork. Another partner might be good at sales. Another partner might be good at the administrative tasks. Larger money pool. More partners, more access to capital. Ease of formation. Forming a partnership is very, very easy. Form on the Government of Ontario website, tick the box called partnership, $60, and 20 minutes later you have a business registered in Ontario. Tax benefits of partnership. This income statement is for Clay Creations. It's a partnership. This partnership earned total revenues of $350,000. The cost of goods and any expenses incurred that year are tax deductible. So, the business generated taxable income of $147,000. Now, a partnership does not pay taxes. The individual partners pay taxes once they've taken their share of income out of the business. So, let's suppose that Partner A and Partner B had agreed that Partner A is going to own 60% of the business and Partner B will own 40% of the business. Partner A gets 60% of the profit, Partner B gets 40% of the profit. How do taxes get paid? Partners A and B each complete their individual tax forms. Partner A pays tax on $88,000. Partner B pays personal income tax on about $58,000. If the business loses money, that debt has to get split up somehow. In fairness, Partner A gets to keep 60% of the profits when the business is profitable, so Partner A is now responsible for 60% of the debts. Partner B, the remaining 40%. If the business was their only source of income and they lost money that year, they do not have to pay taxes. They can't pay taxes on zero income or on a negative income. Disadvantages of partnership. Ownership transfer is difficult. We've agreed that we're going to work together. We haven't agreed that we're going to work with some other person that we don't know. Potential conflict. And unlimited liability. So the business has failed. It has a debt of $200,000. The assets of the business get sold off for $50,000, leaving a debt of $150,000. Now these creditors who are owed the $150,000, they want their money. It's not sufficient to say that, hey, the business closed, we have no money. You have unlimited liability as a general partner, meaning you personally owe $150,000. The question now is, how does it get split up? Well, partner A traditionally has been getting 60% of the profit, partner B 40%, so the $150,000 in debt gets split up 60-40. $90,000 owed by partner A, $60,000 owed by partner B. How do they get the money? Well, they've got personal assets and they have unlimited liability. They could lose their house, their car, their savings. Let's take a look at the second kind of partnership, limited partners. Limited partners are not at all involved in the day-to-day operation of the business. They are mere investors. So here's an example. The limited partner makes an investment into the business. The general partner then provides the limited partner with a certain share of the business, in this case 20%. So the limited partner owns 20% of this business. The general partner owns 80% of the business. When profits are made, 20% of those profits belong to the limited partner in exchange for the earlier investment that they made. 80% of the profits, in this case, would go to the general partner. Limited partners have clean hands. They don't get their hands dirty because they're not involved in the day-to-day operation of the business. They merely made a financial investment. General partners have dirty hands. Limited partners have clean hands. General partners have unlimited liability. They are personally responsible for any debts incurred by the business. Limited partners have limited liability. They are not responsible for debts incurred by the business. The most the limited partner could lose is the initial investment that they made, but they will not be held responsible for debts incurred by a failed business. So in this case, the creditors are owed $150,000. Well, the general partner has unlimited liability. The general partner will owe 100% of that debt, the entire $150,000. The limited partner will owe nothing because they have limited liability. Review. A partnership is two or more people who share in the operation of the business, and they also share in the responsibility for its debt. General partners have dirty hands. Therefore, they have unlimited liability. Limited partners have clean hands. Therefore, they have limited liability.